All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been looking over the internet trying to find information on investing in real estate using life insurance, you've come to the right place. So be sure to like and bookmark this channel so that you can come back to it and check out all the rest of my content. Today, we're not going to be talking so much about real estate, just so much as a basic video on how life insurance dividends work. So if you've ever wondered where the money for the dividends comes from, what it represents, what the insurance company is doing with the money, you'll want to stick around after the intro because I'm going to break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. And the goal of this channel is to simply answer all of the questions that you might have about life insurance and more specifically about investing in real estate using life insurance. The only time you should ever set an appointment with me is when you're ready to see what the numbers look like for you. And if you do come across, if you do have a question that you haven't found in my videos, be sure to post it in the comments down below. And I keep pretty close tabs on that, and I'll get back to you, and you'll have the answer to your question as well as everybody else can benefit from that. So today we're going to be talking about how dividends work. So the goal of this video is simply to explain how dividends and interest crediting in a life insurance policy work. All right, so before I get started, let's just keep in mind a few of my standard disclaimers. There is no advice being rendered in these videos. They are all purely educational in nature. There's no tax advice, no legal advice, no financial advice. And just keep in mind that the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. And then also, if you've got any health issues whatsoever that make you concerned about getting life insurance, be sure to check out my Radical Recovery Facebook group. There's a link to that in the basement. I've got the slide up right now. But in there, I talk about lots of different ways that you can use to rid yourself of these chronic conditions that a lot of people today now seem to have. Just keep in mind that these conditions didn't exist 100 years ago for the most part, and they are all completely reversible. So the way I want to go through this today is just to start with a little bit of the basics, just to explain what the cash value is in a life insurance policy, what the insurance company is doing with the money. And then I'll dive into how life insurance dividends work, how they're paid, and then I'll talk about what is a little bit different in an indexed universal life insurance policy. Then I'll wrap things up. So this is going to be a relatively short video compared to most of my videos. All right, so let's talk about the basics. You guys have all seen this slide before if you've watched any of my videos. And what I'm illustrating here is a graph showing a typical level death benefit life insurance policy. So this is not one that's designed for leveraging into real estate investing. This is just one where somebody wanted $1 million death benefit for the cheapest price they could get. And what I'm showing here are the death benefits and the cash value. The cash value is also labeled accumulation value. They're synonymous. And the important thing to keep in mind is that insurance companies know that they're going to pay a death benefit someday on a permanent life insurance policy. When they sell a term policy, it might be 10, 20, 30 years. But when they're doing their underwriting, they're pretty darn sure you're going to live beyond that, and their policy will not pay out. The policy is really there to cover you in case there's an accident that dramatically shortens your life. And the same is really true in a permanent life insurance policy. But here, the insurance company doesn't want that $1 million liability floating out there, for 30, 40, 50 years. So the premium includes two components. One is the cost of insurance. When that policy begins, they have a risk of paying out $1 million. So the large bracket on the left shows what the risk to the insurance company is. So that's what we call the cost of insurance, or the net amount at risk. It's showing the net amount at risk. The blue line is showing the accumulation of cash value over time. And the cash value is really the second component, which is a savings mechanism that over time, essentially, for all practical purposes, if the insured were to live until their natural expected lifetime, then the policy owner would have saved up the money to pay the death benefit. So each year as the cash value grows, it's shrinking the net amount at risk to the life insurance policy in terms of the cost of insurance. So if we go out to age 80 right there in the center and we look at that center bracket, you can see that at that point in time, the death benefit or the risk to the insurance company, the death benefit is still $1 million, but now the cash value has grown to be $500,000, which leaves $500,000 of remaining risk to the insurance company. So when you're looking at this graph, it should raise a major question, like what is the insurance company doing with the money so that they are growing it over time to basically eliminate the death benefit? And that's the question that I want to address in this next graph. What is the insurance company doing with the money? So let's take a look at this graph, which comes from the annual report of MassMutual. It goes all the way back to 2018. I haven't updated this in quite a while, but nonetheless, these mixes really don't change much. So on the left, under the graph that's labeled total invested assets, you can see that the insurance company has most of its assets in the bond category. So primarily they're investing their reserves in as secure of debt instruments as they can get. But you can also see underneath the bonds is mortgage loans, policy loans, common and preferred stocks. So they buy a lot of mortgage-backed securities off the banks. They make loans to their policy owners. And it's important to understand that those loans to the policy owners, that's not them taking their own money out. That's the insurance company loaning their money as an investment to the policy owner. So the policy owner needs to pay back the insurance company, not themselves. And then common and preferred stocks, those are typically not a very high proportion of the assets of the company. But they also invest in other things like derivatives, partnerships, private securities. They keep some in cash and some in real estate. Now, if we go off to the right, now we're just breaking down the bond category into the various subcomponents. So the vast majority there, again, is private corporate securities, $36 billion. We've got private corporate securities, public corporate securities, mortgage-backed securities, treasuries, municipals, and other assets. So primarily, the point here is that the insurance company is investing in as secure of debt instruments as they can possibly get. So at the end of the year, the insurance company has gains, all the interest income from those investments. So now let's get down to what are life insurance dividends. Well, the dividends are a policy owner's allocation of the net interest gains on their reserves. So all of that money that was invested in all of those bonds, stocks, mortgage-backed securities, they're all generating interest again. And that the company has expenses which get deducted taken from the reserves. But primarily all of the rest of that is allocated out to the life insurance policies. And really, you can almost think of it as a dividend as the return on the cash value portion of the policy. So the more cash value that a policy has, the more it earns. So, $100,000 earning 6% is $6,000 worth of dividends. $10,000 earning 6% would be just $600. So it's the same percentage just applied across the cash value. Now, to circle back to the double play, here's where the benefit of a maximum overfunded policy comes in, because these policies are designed for the maximum amount of cash value right from the beginning. So you're exposing as much cash value as possible to the dividend potential of the policy. All right, so let's talk about what's different in an indexed universal life. So up until this point, a whole life and an IUL are virtually identical. They have the same cost of insurance. They would have the same death benefit for the same amount of premium on the same insured. And everything is identical up to the point where the dividends are paid. So in a whole life, as I stated, the dividend is an allocation of the net gains on the insurance company's reserves to each policy based on the cash value. What's different in an index universal life is that what would have been the dividend, all that interest income, is handed over to the hedgers at the insurance company, or they contract it out to Wall Street firms, who basically hedge and buy options to try and capture as much movement in market indices as they can get. So this is why you see with an index universal life, you see a cap and a floor. And based on the budget that they have, that's the most movement that they were able to capture with the budget that they have to spend on options. So if you see a 10% cap, for example, a 0% floor, well, the 0% floor is there because options expire when the market index goes down typically. So you could buy into the market for less than what you could exercise that option. So one thing I want to point out with an index universal life is even though the performance is pegged to the performance of an underlying index, it's very important to realize that the goal of an index universal life is not to mimic the returns of that index. If you hear somebody saying that or thinking that, they need to be corrected. All the insurance company wants to do here is simply capture a premium over what they would have paid had they simply paid you a dividend in the first place. So the goal is not to mimic the performance of the S&P 500, for example. But if they can do 1 or 2% better than what the interest was on their reserves, they're still, when that is compounded out over dozens of years, that makes a huge difference in the performance of the underlying policy. So again, the goal is simply to capture a premium over what the dividend would have been had they paid it as a whole life. So that's all I've got. I promised this would be a short and sweet video. Actually, I promised it'd be a short video, not necessarily sweet. Hopefully you found it sweet. Again, just to wrap things up, the purpose of this video was to explain how dividends and interest crediting work. And to wrap things up, it's basically the dividend is an allocation of the net gain on the insurance company's reserves allocated out to each policy based on the cash value of that policy. And in the case of interest crediting, they're just basically spending what would have been the dividend on hedging activities. So that's all I've got for this video. If you're hungry for more information and you're not ready to talk to an agent yet, I highly recommend going out to Facebook and joining my double play group there. That's a community of several hundred people who are all interested in life insurance and real estate investing, or clients that are actually doing it. But it's a great source of information. All of my videos are posted there, as well as a discussion amongst the members. Also, there's a ton of information available on my website. There's usually a blog post that corresponds to each one of these videos, so you can check that out if you prefer your information in a written format that you can save and bookmark. And again, if you've got any health concerns that you're concerned about qualifying for life insurance, be sure to check out my Radical Recovery group. And finally, if you want to help out financially to support these videos, check out my Buy Me a Coffee page. So with that, I'll say thank you, and I'll see you in the next video.